Hello everybody, I'm Clara Hammett and this is Breaking the Mould, our regular market review with our investment research director, Russ Mould. Russ, how are you?
I'm very well, Clara. How are you?
Not too bad
Smart
at all.
fringe, like it.
I know, I can see now.
Yeah, I'm only jealous.
Russ, what's the fuss?
Okay, the fuss. Well, we've got 22 FTSE 100 companies, so it's another really busy 2-3 weeks coming up, all about to report interims, full year numbers, trading statements. Picking out that lot, the real fuss, banks, miners and bottles.
Let's start with the big, ugly banks.
Very good choice too. Royal Bank of Scotland has actually got us off to a flying start here with interim numbers that were much better than expected. In fact, so much better than expected, they published them a week early. Pre-tax profits doubled to £2.7 billion. Now, boss Ross McEwen will have been very pleased to see the shares up 10% that day, but did warn, despite improving trading conditions, there were still some legacy issues to bear in mind.
What does he mean by that?
Okay, well, the first one is the regulator still chasing all of the big banks with an extremely large stick. I just asked Lloyds Bank for details. Secondly, they probably will still have some legacy bad loans on the balance sheet from way back when. Perfectly normal for a bank. If you actually look at, say, insolvency statistics for companies, more of them actually fail coming out of a recession than do going in. Because as things get better, they need more money, they need more working capital, and the bank thinks, oh, can't do with this anymore. I'm going to get something out of this, salvage something, move on. So let's see what happens there. In fairness, with the government having a big say in RBS and Lloyds right now, might not happen this time, but that is the sort of thing that banks normally do to heal their balance sheets and get themselves back to full health. Profits rise, they grind out the bad losses, the bad loans. Now, okay, that could, however, put a cap on earnings forecasts, even if it's perfectly normal and healthy. And this is interesting. For the big five banks in the FTSE 100, Barclays, RBS, Standard Chartered, HSBC and Lloyds, remembered them all just, they're forecast to make £36 billion in aggregate this year, £40 billion next year. Now that compares to just about £36 billion in 2007, the top of the biggest credit cycle there's ever been. It's interesting to think that really will conditions be quite that good? Yes, there's cost cutting and so on. I think you're going to need a really, really strong UK economic recovery to support those numbers.
Because estimates have already dribbled down this year.
They have, and this is the interesting thing, is yes, the UK economy is gathering pace, but the numbers are still coming down because I think they were quite over-optimistic. And that's why the banking sector's been a dog. Estimates have dropped 10% this year. That's weighed on sentiment. Okay, RBS has definitely got us off to a good start. Now let's see if HSBC and Standard Chartered can follow up. Interims from those, HSBC on the 4th, Standard Chartered on the 6th. Of the two, let's probably focus on Standard Chartered. It's coughed up a couple of profit warnings of late, and heaven forbid, the board has actually put out, or the company's actually put out a statement denying rumours in the press that Standard Chartered is accelerating its succession planning for Chairman Sir John Peace and Chief Executive Peter Sands.
Ah, the old vote of confidence, eh?
Rather them than me.
It sounds very ominous. Still, should we move on to the miners?
Yes, I think we should. And again, they've not really covered themselves in glory this year either. But rather like RBS for the banks, Rio Tinto has got reporting season off to a good start for the hole diggers. In that Sam Walsh reported, their boss, reported better than expected iron ore production, in fact better than expected production full stop, and the shares have gone from 30 to 34 quid since mid-July. Fair enough. Now when we look at the interims on the 7th, you want to be looking at capex restraint, improved cash flow, and bear in mind that for the full year, the market's looking for about an 8% drop in earnings per share to 300p.
Okay, so that leaves us with bottles.
It does. We've done this one before, but let's do it again because it's the FTSE 100 company that nobody's ever heard of. Coca-Cola Hellenic Bottling Company, CCH for short. Now, it's based in Switzerland, was listed in Athens, is now listed in London and has been since last autumn. And it's Europe's biggest bottler and seller of Coca-Cola products. Quite a lot of customers out there. It's potentially quite interesting. But despite that, no fizz from the shares at all since they moved to London, down from 20 quid to 14 in, well, just about a year, really. So they need to do something about that, and quickly.
Yeah, so what can they do about it?
Well, it's a good question. I mean, in the end, it's very heavily exposed to Eastern Europe, and particularly to Russia. So again, they need to, obviously those countries are all in the, the news for the wrong reasons at the moment. So really what they're looking to prove is they can perform their way through that. If you look at the first quarter statement, case volumes were down 4% to 410 million. Sales were down 7%. I think the market's going to be looking for an improvement in that momentum before it starts to look at the stock again.
Okay, thank you, Russ.
Pleasure.
Thanks for joining us on Breaking the Mould. We'll be back with you soon. Until then, enjoy the sunshine. Goodbye.